Do you feel it? That constant shift beneath the surface of our energy markets? It's like the land itself, unpredictable and volatile, yet full of potential. The energy landscape is changing fast, sometimes too fast for the big players to adjust, and that's where the corporate giants stumble. There's room for smaller, more nimble players to step up and show what's possible when you focus local. Think practical, and dare to do more with less. Hi, I'm Mark Roach, and welcome back to FutureWise Energy. This is where we bring clarity to the chaos of the oil and gas world, celebrating community-based practical energy solutions that honor both resilience and common sense. Today, I'm breaking down some of the latest trends in upstream oil and gas, from market shifts to M&A news, workforce updates, and geopolitics, and exploring how smaller, community-driven energy solutions can not only survive, but thrive in this environment. First, let's talk numbers. This week, WTI crude has settled around $68.19 a barrel. That's down 2% from the day before and roughly 18% lower than what we saw a year ago. For natural gas, the Henry Hub spot price showed a small dip, clocking in at $3.21 per million BTUs. Now, here's what's interesting. These price movements signal a cooling off of the so-called war premiums. Geopolitical tensions, while far from resolved, have eased up just enough to release some of the upward pressure on prices. But dig deeper, and you'll see that oversupply and softening demand are playing an even bigger role, particularly as summer heat and with it, peak seasonal energy usage starts to wane. For smaller and community-based producers, though, this environment may actually bring opportunity. Rising input costs are painful, yes, but with these cooler prices, local and adaptable players might capture demand that larger operators are too bloated to respond to nimbly. On the supply side, the signs are clear. U.S. crude inventories grew by 7.1 million barrels last week. That's 2 consecutive weeks of stock builds, even though gasoline stocks have been ticking downward with the usual pre-summer driving demand. Natural gas injection into storage is strong too, with volume 6% above normal seasonal levels. Yet here's the catch. The drilling side of the equation is softening. U.S. output forecast for crude just got revised downward again. Instead of 210,000 barrels per day increase for 2025, we're now looking at closer to 160,000 barrels per day. Why? Rig counts are dropping, particularly in well-known basins like the Permian, and this speaks to the hesitance of operators to overcommit amid volatility. For the smaller producers, and I can't stress this enough, this creates a window of opportunity. Fewer rigs and slower activity mean less competition for execution resources, and perhaps a better shake for drilling efficiencies. I'm talking about practical planning and disciplined budgets, the very thing that define well-run, community-focused operators. Shifting over to upstream deal-making, 2025 had a roar, to start in M&A back at the beginning of 2025. And to date, we've seen $17 billion in deals, the second best streak since 2018. But here's the rub. Activity is definitely slowing. High asset prices and weaker crude prices are making buyers think twice. Big players like Diamondback Energy and Diversified Energy made headlines earlier this year with massive acquisitions in the Permian, and while consolidation strengthens industry giants, it forces smaller independents to fight harder for capital and relevance. But here's what the concept of small is beautiful is and where it shines. While larger, less agile corporations focus on pure efficiency and shareholder returns, smaller operators can pivot to the needs of their communities. They bring something the majors often can't: authentic integration with local systems. They're grounded in people-first relationships and localized decision-making. Now, what about jobs? The upstream workforce has been steadily recovering in places like Texas, which added 7,000 positions in the first 5 months of this year. Nationwide, hiring is more cautious, a selective do more with less attitude, but still ongoing. Rig counts are down compared to last year, and oilfield service jobs dipped slightly in June, though the sector is holding steady. This careful approach to staffing underscores a simple truth about this business. Discipline is king. It's not about who drills the most wells, it's about who drills the smartest. For smaller players, this is a huge advantage. They can bypass bureaucracy, refine workflows, and innovate precisely where it matters most, keeping operations lean but impactful. Lastly, I'd be remiss not to touch on the geopolitical backdrop shaping everything. Between ongoing OPEC maneuvers, easing trade wars, and new U.S. sanctions aimed at Russia, it's clear we're living in an era where politics drives just as much of a market movement as geology. But here's the key point. This volatility creates space for nimble, values-driven energy solutions to prove their worth. Small, community-based operators aren't burdened by sprawling international supply chains or mega project timelines. They can pivot quickly, they can compete locally, they can anchor themselves in transparency and proximity, offering communities not just energy, but stability. At its heart, this business has always been about scale and resilience. The big operators have scale, but too often they struggle with agility. Smaller players, well, they bring something larger companies can't. They're part of the fabric of their communities, ready to adapt in ways that matter most, where it matters most. Change, as always, is inevitable, but it's the response to that change, the willingness to adapt and innovate, that separates true leaders from the rest. I'm Mark Roach, and this is FutureWise Energy. Thanks for joining me as we explore how small, community-driven energy players are rising to meet big challenges. Stay curious, stay resilient, and above all, stay focused on the fundamentals. See you next time.